We begin right here with what some are starting to worry could be IPOs gone wild. Check out the monster move in some of these recently public names. Beyond Meat, Smile Direct, Uber, up double digits this year. In fact, Smile Direct up 34%, Uber up 17, Beyond Meat up 55, and we're only 9 trading days into 2020. Now, many of these names are still well off their all-time or IPO highs. So is the recent rally too far, too fast? And if so, which Guy Adami of those names, if you had to pick one of those names that we showed, would you say this is the worst and most egregious example of momentum gone amok?
Well, I mean, the most egregious example out of those names, momentum gone amok. I mean, Beyond Meat, I think, is fascinating to me. I mean, the stock went from 75, seemingly the current levels in a straight line, but it's also off from that $240 level that we saw, I don't know, back in July. So I don't know if it's necessarily run amok. To your point, they're still well off the highs. I think the bigger picture, or sort of the broader theme here, is we spent a lot of time talking about WeWork a few months ago, and it's not that it's that particularly interesting, but I think one of the many unintended consequences of central banks, specifically our Fed, is they've made people lazy. They've made investors lazy. And what do you need to know? Well, SoftBank was supposed to be the greatest investors on the planet. They invested at WeWork at a $47.5 billion valuation, and that's now 80% less. If that were a publicly traded company, we'd talk about it every day. Now it seems to be happening in publicly traded companies. I think that's a reason for concern. I don't think, it's necessarily the red flag, but it's one of many red flags.
Well, I agree on the Fed analog. And if you think about where we were a year ago, we were actually pricing in, if you looked at the forward curve, 3 Fed hikes and continued unwind of the Fed balance sheet. Well, we did exactly the opposite in 2019. We got 3 cuts, and we essentially, by the end of the year, added $400 billion to the Fed balance sheet. That, to me, is essentially what Guy is talking about. This is the manifestation of that. I don't think every one of these companies can be painted with that brush. And if I had to take one of those companies that I actually think is kind of interesting, I think it's Luckin. And I think it is based upon, obviously, they are the opportunity to be Starbucks in China. You probably know this metaphor. We talked about this last week, Karen. Remember, they did a convert issuance and the stock got killed after that. And some of the biggest hedge funds in the world are in this name. So do you want to be buying essentially their convert, except for the fact that I do think these guys are taking market share and I do think they are competing locally. That's a growth story I like.
I think, Karen, the point of this exercise is that maybe all these names are great. Now, they were ignored, many of them, or sold at their IPO. So something either fundamentally has changed with the story in the past 3 weeks, or this is just algos and hedge funds and high-frequency traders riding the tape until they can't anymore.
I think that is the main thing driving it, though. But one thing most of these stocks, if not all of them, have in common is big short interest, right? So that just starts a sort of a virtuous or vicious cycle, depending on if you're long or short, of buying. So, you look at like Beyond Meat, 25%. Smile Direct, which to me is the most volatile, 56% short interest. So that really...
Sorry. Guy, I need to apologize to you because the last time we talked about Smile Direct, I suggested you might benefit from the product, and I got a lot of nasty Twitters.
And I said back that, unfair. I grew up in northern Westchester, not southern Westchester like you. We didn't have the funds for orthodontists, and you were making fun of me. I have feelings, too. I just wanted to, but that's okay.
I'm glad you guys figured it out. Let's bring it back in, Karen.
A couple of things about Smile Direct. Yes, it's been on a tear for the last week. They've had some really good news with Walmart and now wholesale to orthodontists. That's actually big news. But remember, this stock was 4 or 5, and now it's 1170 something after a huge run. So, I mean, some of these are just gaining share, gaining price back.
The point is they had news. Smile Direct BK had some news that they're going to sell through orthodontists, which, by the way, was their entire unmodel. I mean, is that a word? Like, the whole model was don't sell through orthodontists. Now we're like, we're going to sell through orthodontists. But at least they had news. Many of these other names are just trading on no news.
Well, and it's the short interest. In my view, it's the short interest, right?
That will run out.
That will run out.
And so everyone covers.
I think you take this list of stocks and put it up there and say, when the market starts to turn over, these are the ones you either want to short or you want to sell. Smile Direct being number 1 on the club. I mean,
why is that?
Well, primarily you think about dentistry and cosmetic dentistry. That is the first thing you're going to cut out if for some reason there's a recession or your paycheck's cut or you're not making the kind of money that you used to make. The first thing you do is cut out your cosmetic dentistry, whether you need it or not. So that's number 1 on my list to short. I'm not doing it now because of the 56% short interest. This thing could still keep running.
You could still get blown out.
Yeah, you could still get killed.
Tim, would you agree this is not the time? If you're thinking, I don't like Beyond Meat, I don't like Smile Direct, I don't like Luckin, this is not the time to short these names?
Well, I think you can have a plan, and you can certainly take exposure on the option market. I think you can measure your risk, and I think if the valuation is absurd, I think you don't necessarily need to put it all on today, that you can leg into the trade. I will just say that if you remember back, it was only October when high multiple story stocks, structurally unprofitable, were the last thing you wanted to own. It was not that long ago. We were having this exact conversation in reverse. We will get back there. It doesn't mean that these are all bad companies. It's going to come back to valuations in the market. When we're in a risk-off environment, these will be the first to go.
Yeah, I could throw two more names on here, Guy Adami. Occidental Petroleum, down 28% over 12 months, up 14% this year. I could throw in L Brands, down 24% over 12 months.
Those are different,
up 10.5% this year.
Sorry, Guy.
No, but I don't know. Jump in. I don't know what has changed with those names.
They're different, but they're very similar in that there's been news out with L Brands specifically. And quickly, I'd like to go off the board for 500, if I may, in this conversation. But we didn't mention Lyft in this conversation, but I think Lyft is much different than Uber. That's a company with a pathway to profitability. The last 2 quarters have been good. They report in a couple weeks. You've had this stealth rally in Lyft. I think this is a name. I don't think it's going to get back to that $63 level that we saw over the summer, but I think it's destined to trade in the low 50s, and percentage-wise, that's a big move.
Quickly, though, Brian, I mean, you're someone that spends a lot of time focused on energy. I think the turnaround in Oxy is really all about a reassessment of the energy sector in terms of the bottom-up fundamentals. Companies being run for equity investors again. The fact that we're seeing energy prices and commodity prices, CRB, Rhine, things that are actually starting to accelerate after years of basing. I think the energy sector is very different.
I think a good lesson here, though, is you want to own a stock, go to CNBC.com and check out the short interest. You should always know what the short interest is in a name that you own.